This is something you may be familiar with a little bit, your Porter's five forces. And I don't know, I don't remember if you maybe did this in your marketing class or your strategy class, but it's just a way to kind of organize your thinking about a company and perhaps how profitable that company can be. Because when we're talking about stocks, we're going to get into taking the present value, basically of the cash flows, right? And the cash flows are a product of the profitability and the investments that the company makes, right? And so profitability is pretty important. So here's kind of how the model works. One, it looks within the industry first. And it asks the question, how is competition within the specific industry? Is this company that we're analyzing, are they very strong? Can they raise prices? Or is there so much competition that they can't raise prices at all and they're constantly competing for customers? So that's one of the five forces. If we're trying to predict industry profitability, we have to look at the competition level within the industry first, right? I mean, it used to be like airlines, there was tons of competition, companies coming in, companies going out all the time. And so it was very, very difficult for airlines to earn profits. We're starting to see a little bit of a change now, because a lot of the competition has been gone away that we used to have. And but that's just an example. Right. I mean, think of a company like NVIDIA, right? For AI computing chips, right? Not a lot of competition there. So here are some of the other things that you have to think about when you're looking at an industry. Are there potential new entrants who could come into the industry and compete with the companies already there? Okay. If it's easy for other companies to come into the industry and compete, it's going to be very hard for that industry to earn abnormal profits and make really strong returns for you. What is the bargaining power of suppliers? So every industry has to buy stuff, right? And then they do something to it and then they resell it, right? So how strong are the suppliers? Do the suppliers have more power so that they can negotiate better prices that give the suppliers more profits than, say, the industry that we're talking about? If the suppliers to that industry have a lot of bargaining power, that's where most of the profits are going to be. I mean, think about like NVIDIA, right? They're supplying processors to all the data centers, right? And so these data center stocks, they pretty much have to buy the processors from NVIDIA, right? And so NVIDIA is going to have most of the power here. So I would think most of the profits are going to go to NVIDIA and not to the data centers. Substitutes. Are there substitute products that customers can choose instead of this industry? Right? So think of like, I don't know, what if this was oil, petroleum, gas, right? Well, what if people could pick solar power instead? That's kind of a substitute product in a way, right? So depending on how strong and competitive these substitutes are, that will take away the profitability of this industry that we're talking about here. So these are the five different forces that could affect how much, in a way, pricing power the industry has that we're talking about. And the last one is the buyers. How much power do the buyers have? Do they have a lot of negotiating power? If these buyers don't have much negotiating power, these are the buyers who buy the stuff from whatever industry we're talking about here. If they don't have a lot of negotiating power, then most of the profits are going to wind up here. But if the buyers do have negotiating power, then it's going to be hard for this industry to create profits and grow their business. All right, let's take a look at the government and the economy. It's pretty important. You think okay, the U.S. is a purely business capitalistic society or something like that, right? But the government still has tremendous control over the economy. And I think lately we've probably been seeing it more so than ever. And the government can affect the economy the way we classify it two different ways. One is by fiscal policy, and the other one is monetary policy. Fiscal policy is like, think of like Congress and stuff, like the executive branch of the government. So Congress and the executive branch of the government, they do taxes. And so if they decrease or increase taxes, that can take money out of the economy, right? So if they drop taxes to nothing, then more people have more money to spend, right? Or if they increase taxes to a huge amount, then there's less money to spend, but then the government starts to spend the money. And so that's the flip side of taxes, is government spending. So the more the government spends, the government can actually spur the economy on. And so you will see this when we go into recession, right? Very often the government will pick up spending. I remember here, right, it was like 2008, 2009. You guys may not remember the financial crisis, but there were tons of like construction projects funded by the federal government. Like a lot of all the roads around here in by campus coming up the hill, Mission Boulevard, everything, all of it was redone. There's tons of construction work, and that was because the government wanted to help the economy grow and get out of that recession. If you go back to like the Great Depression, was it FDR? He had these the civil works projects that helped get the country out of the Great Depression. And a lot of the buildings and stuff that you'll see at a lot of the national parks, a lot of them were built in the 30s from these like civilian corps, where they're trying to like give people jobs to get them, spur the economy back. So government spending is a big one. The more the government spends, it'll help the economy. But again, it's kind of like salt in a way, right? A little salt is good, but too much salt can be bad. And so what's the right number for things like taxes and government spending? That's not for me to decide. But these are some of the tools and the levers that the government has to affect the economy, at least in the short term. So this is like Congress, the president. That's right there. Then down here, monetary policy. This is the Federal Reserve Bank. All right. This is when they're talking about, what's going to happen to interest rates every month or so, right? This is what we're talking about. And the Federal Reserve has a couple mandates. And they're supposed to be kind of like independent, because if they weren't independent, sometimes, the politics of things can push people to do things to maintain, themselves in office, but even though some things may not be good long term, that's the idea at least. So the Federal Reserve, they have a couple things that they're supposed to work on. In fact, they kind of call it a dual mandate. They're supposed to do what they can to help the economy, to make sure we have full employment. I think full employment is something on the order of like 3 to 4% unemployment rate. It's not 0%. And the other thing is price stability, aka inflation, right? Sorry for my writing there. Price stability. And that's kind of how, and I mean, overall, they're trying to help the economy do better. And some of this goes back pretty far when, they had the Morgans and stuff like that, big banking families that would sometimes do things that the government wasn't doing. But pretty much now, since I would say the last 50, 60, 70 years, the Federal Reserve has gotten, they really get involved in managing the economy. Right, so here, so in order to meet these goals right here, the dual mandate of full employment, price stability, and sometimes it's a balancing act, right? Because to get full employment, what they would do is they would lower interest rates So people can, one, buy more stuff because they can borrow more money, and companies can borrow more money and build more factories and make more stuff. So they lower interest rates so people buy more stuff, do more stuff, and then more people have jobs. Okay? And but the problem with that is if they lower interest rates too much, people start buying too much stuff, that companies start running out of stuff, companies will start raising prices, and then you get inflation. And so it's kind of a balancing act, right? If they lower interest rates too much for too long, yeah, employment is full, that's great, but now we start getting inflation. So then once inflation starts going up, then they have to start increasing interest rates. When you get higher interest rates, people start borrowing less money, companies borrow less money, people and companies start buying less stuff, and now the thought is that prices should start coming down. Yes, if they do too much of high interest rates and price and companies' sales go down too much, then people start getting laid off. So that's why this is kind of like a balancing effect of controlling, the economy and interest rates back and forth. Where if they do too much of a good thing, they're going to hit the other problem. And so how do they do this? But they control two things. First off, let me start with the interest. These are short-term interest rates. So banks have the ability to borrow money from the Federal Reserve. Okay, they can also borrow money from other banks, but like every day that a bank exists, they have to meet certain asset and liability requirements, right? They can't just like take cash in and then lend everything out and not have any money left in the bank vault. They have to have a certain amount of money left in the bank in case people want to withdraw money, right? And so every day, every night, they have to meet these requirements, these financial ratios. And so if they're a little short, they can borrow from banks, or they can borrow from the Federal Reserve Bank to make sure they have enough money on hand. And so that's what this is. This is the rate that the Federal Reserve actually lends money to other banks. So if you think about it, the Federal Reserve is like the bank for the banks. And that's short-term interest rates, okay? And then we have, they can also adjust the supply of money. And they can adjust the supply of money a couple different ways. And let me explain why the supply of money would also work to affect interest rates, right? Because if you actually take money out of the system, circulating money in our economy, if you take money out, there's going to be less money to lend out for the banks. And if they have less money to lend out, there's going to be there's going to be competition for a lower amount of money to be lent out. And so actually the cost of money, which is interest rates, goes up. It's kind of like from your econ class, remember supply and demand, right? If supply goes down, there's less stuff available. People are going to be competing over less of a supply, and so prices go up. It's just like, if there's a bird flu and there aren't as many eggs being available, the price of eggs goes up. And we've seen that the last couple of years, right? And so if they bring the supply of money down, it's like bringing the supply of eggs down. And so the price of money goes up, just like the price of eggs. And the price of money is interest rates. So when the supply of money goes down, interest rates go up. And this is more of an indirect way of adjusting interest rates. The federal funds rate is direct. They kind of say, this is what we're going to do it at. And then the economy kind of follows and the banks all follow on the short-term interest rates. Or they can increase the money supply. They can actually start spending money, right? And they can increase the supply of money. And when banks have more money, they'll start lending more. So that if the supply goes up, the price goes down, right? And so if all of a sudden chickens lay 5 times as many eggs as we're expecting, now there's a glut of eggs, and so farmers are going to start dropping prices to make sure they can sell everything. right? So if the supply of money goes up, price of money goes down, and the price of money is interest rates. So if the supply of money goes up, interest rates will go down. And here's how they can change the supply of money. One, they can change what the banks in our economy have to hold in reserve, right? Banks can't just lend out everything. They have to keep a certain percentage of the money of their assets in cash, if you will, like, on their own bank accounts in the vault. And so if the Federal Reserve says you banks have to keep more money within and not lend it out, that decreases the supply of money that's being lent out, and interest rates go up. The Fed can also do something called open market operations. And that's where the Fed actually goes out into the markets and starts buying up bonds. And if a Fed goes out in the open markets and say they take this bond and they say, hey, bank or hey, investor, give me that bond and here's some cash. Now all of a sudden there's more cash floating in the economy. So it increases the money supply. And if they increase the money supply, interest rates go down. This is why, if you remember, after COVID in 2021, 2022, we had really, really low mortgage rates. And that was because the Fed was buying long-term mortgages and money-backed securities, mortgage-backed securities, and longer-term treasuries to lower interest rates and get the interest rates down. In fact, they've been doing that since 2008. I know it's a little different right now, but they can go out in the markets, buy up bonds, and when they buy the bonds, they give cash, right? And so that puts more money in circulation. On the reverse side, they can sell bonds. And if they start selling lots of bonds, investors have to pay cash. It takes money out of the circulation. If they start selling lots of bonds, and if they take money out of circulation, interest rates will start going up. So so it's largely through interest rates. Mostly we see it through short term, but they can do it with long-term stuff as well through the money supply. And that's again to help adjust, keep the economy doing well. Here's an example of some of the things they can do. So first off, let's say that we're getting a lot of inflation, right? This is kind of what we've had the last couple of years, I think, right? The Fed will adopt something called tight monetary policy. And this is to reduce inflation and, and slow down the economy a little. And so what they can do is, one, they can sell securities through open market operations. They can sell bonds, and then investors have to give cash to the Federal Reserve, so that takes money out. They can raise reserve requirements at the banks. That means banks have to hold on to more cash. They can't lend it out. Or they can raise the short-term interest rates. And that all of those decrease the supply of money, and interest rates will go up. And these are just little supply-demand charts. So the idea is that economic growth and employment falls, people spend less, and then prices should start coming down. So anti-inflationary. That's the idea. Here is on the flip side. So expansionary or loose monetary policy, its goal is to increase jobs and grow the economy. So they can start buying securities through open market operation. They give cash for securities, putting more cash into the economy. They can lower the reserve requirements, tell banks, hey, you guys, go ahead, lend out more money, and they can lower the short-term interest rates. And that increases the money supply, which will decrease interest rates. And ultimately then, economies, more people borrow money, they buy more stuff, and hopefully more people get jobs. This is a way of looking at kind of a top-down analysis when we're looking at where to invest. It's called the EMIC, Economy, Market, Industry Company. It's a way to structure your economic analysis to figure out where to invest your money. It's top-down. The alternative to this is something called bottom-up. surprisingly, right? Bottom up is where you just like, you start looking for really good investments to make. You're not worried about predicting the economy, where it's going. Let's just look for really good stocks to buy, okay? That's kind of like, maybe that's a little bit more of the Warren Buffett approach, is the bottom up. The top down, which is which kind of like, okay, it asks the question, okay, before we get to picking our stocks, let's first look at the economy. How's the economy doing? What phase of the economic cycle are we in? And how's unemployment? How's inflation? How's interest rates, right? Because depending on how the economy does, different companies will behave differently during different parts of the economy. Once we've got the economy down, why don't we think about the markets? And what I mean by the markets is like asset classes. Do we want to invest in bonds, or do we want to invest in equities? Do we want to invest in international equities or international bonds? So once we figure out where the economy is, pick the markets, fixed income versus equity, global versus domestic. That's on our way. That's from the top down. And then once we know where the markets we want to invest in, let's pick industries. So we know, like, let's say the U.S. is just starting to do really well. We're going to an expansionary phase, and which means like consumer discretionary is going to start doing well. Let's look at some consumer discretionary stocks to buy, right? Because of certain industries doing better during different periods of the economy, cyclicals and that. And then we can start, once we have that down, okay, which company should we buy within the industry? And that's where you start looking at, your valuations, how much debt companies have, the products, the strategies, are the strategies good? So this is together collectively EMIC top-down framework for analyzing companies ultimately. This just kind of shows, overall the effect that the economy can have on the valuation of the firm. So the idea here is, okay, we're going to value the firm. That's coming up in the next chapter, right? And to value a firm, we kind of have to understand, okay, if you think about the broad classes of economic variables that affect a company's, sales and profits, one is, how's the overall economy doing with GDP? Some companies are sensitive to employment numbers. Inflation can be a big one, and interest rates are very big. So those are kind of like the four big classes of economic measurements that we have. And these four big classes, if you will, they get further separated into things like household decisions, right? Are households spending money, or are they saving money? And this kind of is related to some of the GDP and employment and even inflation. Are businesses hiring or investing? Are they growing their sales? Fiscal policy in terms of taxing and spending. Monetary policy in terms of expansion or restrictive monetary policy. And then there's always the potential, external shocks. Is something happening with, hurricanes? Is there war, gas prices? That can all affect where we're at. And so these are the more detailed numbers, and they feed into predictions about overall GDP, employment, inflation, and interest rates, which then go into our firm valuation. Here's an example of some of the economic indicators used to judge this. GDP, sometimes people look at industrial production, consumer confidence, housing starts. And, if you listen to economic news, you'll hear some of these numbers being announced. And then sometimes the stock market will be affected by some of these numbers, because a lot of the stock market is driven by, automated trading programs, and they're constantly being fed all the available information. This one's interesting. The stock market is probably one of the best leading indicators of the overall economy that we have. Employment, we use unemployment rates, initial jobless claims. Sometimes you hear average hours worked. Inflation, usually like CPI and PPI, Consumer Price Index and Producer Price Index, right? And then interest rates, we often look at, 1 year and 10-year interest rates. Those are probably the biggest ones we have. We don't hear about this as much anymore, but it used to be, you used to hear about it more, how countries would start playing with the value of their currencies to either to kind of help their domestic companies export. And nowadays it's like all the talk is about tariff and stuff like that. So this isn't talked about as much, but let's check it out. So here's the thought. Imagine if the U.S. dollar dropped in value, right? It was really weak, so that like if you went on vacation out of the country, because of the weak dollar, when you go to convert your money over and buy stuff in another country, everything's really expensive, right? So when you take your U.S. dollars and you buy stuff somewhere else overseas, for you in the U.S., it's really everything else looks really expensive because your dollars are weak. They can't buy a lot. But on the flip side, if the dollar becomes very strong, now you can go overseas and everything looks a lot cheaper because your dollar is stronger and you can convert it into more of the local currency. So this has an impact on companies that import and export in and out of the country. And so, for example, here, let's stick with weak dollar. Exporters, when a company manufactures something in a country and the currency gets devalued, now it's almost like the manufacturing costs are really low. And so when they go to export to another country, their product looks really cheap. And so a weak dollar actually helps exporters, U.S. exporters. Conversely, if someone is buying product from another country and the dollar is weak, they can't buy as much stuff. So imported products are going to cost more. So the idea is there used to be this thing where countries would try to purposely make their currency weak to help them export products. But I think over time, maybe the last 10, 20 years, I think countries have stopped doing that as much because, if one country does it, then another country will respond and do the same thing with theirs. And it just becomes like a tit for tat and nobody's better off in the end. So I don't think it hasn't been as big of a deal anymore. And there's also some negative impacts if a country wants to weaken their currency. This output expansion from reducing your currency, sometimes it's only short term because, like I said, another country will then weaken their currency in response so that their exporters are okay. And so the thought is that long term, the economy for that country, if that's all they do is keep lowering the value of their currency, is that historically it's shown that long term it's not a good thing to do. And then you get inflation from rising import costs. So this is kind of a summary page. So in general, if there's positive economic news, think about positive economic news, the economy's doing well, what you're going to see is riskier assets will do better. Riskier stocks will do better than safe stocks. Riskier debt will do better than safe debt. Okay, so risky debts outperform during good times. But if we get negative economic news, right, that's where there's kind of they say a flight to safety. And so safe assets will do better than risky assets. Treasury debt will do better than corporate debt. Fixed income in general will do better than equity. Safe stocks will do better than risky stocks. Okay, so it's kind of a way to kind of simplify things down to go, no-go decisions, yes or no. All right, so that's it for Chapter 12. And then in chapter 13, we're going to start talking about stock analysis, equity analysis.